Thank you so much for joining us for this episode of Leading Change. My name is Emma, and I have Michael with me today, and we're going to be talking about pricing kind of across the entire insurance landscape in little bits and pieces. But before I get to all the questions that I've got for you, can you give everybody an introduction?
Yeah, Emma, thanks for having me. My name is Michael Nadel. I am a senior director with Simon-Kucher Partners based out of Chicago. A little bit of background, Simon-Kucher is a global strategy consultancy focused on growth-oriented topics. And one of the things that we specialize in is pricing and pricing strategy. And so I do a lot of work with firms across the insurance ecosystem, from carriers through service providers like TPAs, managed repair companies, and insurtechs to help them figure out their pricing and their growth strategies.
Great. Well, thank you for joining me. And as I teased, we're going to kind of start things off by talking a little bit about why pricing is specifically, and I guess like the limelight right now. It's probably not like a good light to be shed on right now, kind of across that whole ecosystem or kind of start to finish in the insurance industry. So can you talk a little bit about like what's causing some of that focus?
Yeah, I mean, I think firstly, the reason we're hearing so much about pricing in general right now has to do probably with the inflation that we faced in the US over the past few years. Pricing has just become top of mind for everybody in their everyday life as we're talking about prices of goods at the grocery store and different places. And that bleeds into every industry, across the globe, and insurance is one of them that is impacted. So there's talks about pricing in the insurance industry, both on the product side as well as for the folks that are selling goods, services, and software into the insurance industry. I think the other reason pricing is becoming more important at the moment is probably due to the way that funding is working right now for those that are looking to raise funds and build their own startup. So the past decade or so has been very favorable in terms of interest rates, allowing a lot of free-flowing funding of capital from the VC and the private equity markets. And when that money is flowing, the focus is on growth. And in growth modes, people are more sort of open to using penetrative pricing strategies or using price as the means of getting in the door, with a focus on revenue growth and bottom line profitability sort of as the secondary when that second round of funding or third round of funding or just the backstop of funding essentially is behind you. Now, we've seen markets start to dry up or capital start to dry up as interest rates have gone up. VCs and PEs are being more selective about where they choose to place their funding. And what that means for startups is they need to create more runway for themselves as that next round of funding is not necessarily guaranteed or as easy to come by. And so one of the levers that companies are now starting to focus on is pricing. So how can I use pricing to generate that revenue and straight to the bottom line type of profit that pricing does if you keep your cost model the same in order to generate those longer runways for the funding cycles that many of these startups or service providers have.
So when we take a look, then there's also, a lot in the news about the price of insurance and policies as a whole, and lots of conversation surrounding how regulation comes into that and underwriting comes into that and all of these things that go into placing a price on an insurance product. Yeah. But maybe beyond just the underwriting side of things, where do carriers potentially have levers that could impact this whole pricing conundrum?
Yeah, I mean, I think there's a lot of misconception on the consumer side around the increase of pricing that occurs on an insurance policy. And you can't blame the average insurance customer because they're not thinking about their insurance other than the moment that they need it. So you go a year without having any type of claim, and all of a sudden you're shocked to see that your auto insurance went up 20 to 30%. But the realistic nature of that is that prices of insurance are dragging behind the actual event that's causing the price to increase. So insurers have seen replacement costs go up dramatically on, if we're talking about auto in particular, have seen the cost of replacement costs on parts and services go up as inflation has gone up and as the supply chain was really constricted as a part of COVID. And so we're now just sort of seeing the impact of that come out cycles later, 6, 12 months past the impact of some of these things, as each insurer has to go out and get the regulatory approval for the increases in premium that they're trying to drive. I think the same thing is sort of true with, I know I'm a little bit off topic of your question, but I'll get back. But what we're seeing in states like California and Florida on the perception of the customer, of insurers leaving certain states because those same regulatory bodies won't necessarily allow them to get the price increase that they need to justify the risk. So you're seeing carriers like State Farm and others start to leave states like California where it's becoming difficult to insure. So to your original question, though, what can insurers sort of do to control price or the impact? Underwriting and actuarial is sort of the clearest kind of path that they can take there. Really understanding the risk that's in front of them and being able to segment it or define the rules best to be able to actually categorize a group of people and give them the appropriate price for their risk profile. I think there's a really interesting case study that I've read about Progressive and their approach to actually finding a very profitable segment for them in a very risk-driven space around drivers that had DUIs. They were able to identify a segment of customers that had DUIs as actually being much lower risk than the perceived general pool of folks that had DUIs. They looked for certain characteristics of customers in this bucket and were able to say, well, if you've had a DUI and you meet these certain characteristics, you're actually not the same risk profile of the generic customer that had a DUI. And so they could adjust pricing slightly on these customers, still generate significant revenue, and actually create, insurance that's at a price that these customers couldn't have gotten otherwise. So, that hits on the primary way that they can control price through that underwriting piece. The other aspect of it is, insurance is a cost plus model at the root of it. And so all the costs that an insurer is taking in are driving the ultimate price that they can charge for customers. So if you're a software provider selling something into an insurer, you're impacting that expense ratio, which is ultimately going to drive cost on the consumer side. So if your software is not generating the ROI or actually the end savings for a customer, it's actually driving towards the price in that cost plus model for the insurer. One thing that we've been working with insurers on recently to create some of this price differentiation is really looking at the product itself and trying to understand, if you break it down into different structures or different offerings instead of a sort of one size fits all product for customers, you can start to create some of that price differentiation by removing certain features, that we might consider high value add-ons or premium levers, and creating more sort of base or bare bone entry type of products that still attract the customer base that you're going after, but give them the price flexibility that they might be looking for.
So we focused on the carrier side of things, and now we're looking at the other side of the spectrum. So you mentioned things like TPAs or insurtech providers that you guys also work with. So what are some tips that you have for them as they're kind of like fitting into this overarching pricing spectrum?
Yeah. So one of the things that I typically think about and we talk to our customers about as it relates to pricing is that pricing ultimately is just a measure of value, the same way a foot is a measure of distance, right? And so when you're putting a price on your product, when the customer is ultimately purchasing, they're measuring their own sort of internal measure of value. In economics, they call it utility or utils. And they're saying, does the price that's being charged for this product ultimately match or exceed the value that I am getting from this product? If the price is higher than the value of the product that the value that they are getting from the product, they won't purchase it, right? And so as a service provider or as a company selling software, your goal is to try and match that as best as possible. And so there's a number of ways in which it can be done. In software, ultimately, we're often talking about packaging strategies that allow you to create differentiated pricing to match to all of the different segments of your customer and take advantage of these different price points, customer needs, and create offerings that match to multiple different price points. Once you sort of understand that thought process around matching the price to value relationship, one of the things that we first do with customers is to understand what their value perception is in the market as it relates to their products as compared to their competitors. Very often when we go into companies, really across any stage of company, Series C all the way to Fortune 500 companies, there's really varying degrees of understanding of your competitive position in the marketplace. And very often it's internal perception that has plagued organizations for years and years and built up stories internally of this is our place in the market. Here's how people perceive us, but very little of the research is actually occurring to go out and speak to customers and get that viewpoint. And those internal stories can often be sort of the death of growth in certain cases because people are afraid to produce the pricing strategies that are necessary. So one of the first things we'll do with customers is go in and try and help them understand where they are perceived in the market in that price to value relationship. The next thing is really, if you shortcut the whole process, is understanding how customers value the pieces, parts of your products or your service offerings. This can be used to help to develop those packaging strategies. If you're, say, a software vendor and you want to take advantage of multiple segments, customer segments in your marketplace, you're able to use packaging to sort of capture that willingness to pay of multiple different customer segments. Once you sort of understand that value and the way that customers are looking at your different offerings, it can help you to develop those packaging strategies and or to set the right price for your product. And then finally, it's setting the price and choosing how to charge for the product. And often we find customers sort of focus too much on what the price should be versus how you actually charge for the product. One thing we often find with companies in their growth journey more often, let's call it Series C or so, is that we'll come in and say, well, how did you set the prices for your product? How did you choose the metrics that you were going to charge for? And often it stems from the very first revenue generating opportunities that they had. They established a way to charge for their product and a price to set for it. And that has just sort of continued on without a refresh or review of whether it's optimized for you to generate the right type of revenue. So we'll come in and we'll have these conversations with customers to figure out, do you appreciate the way that you're being charged for these products? I've worked with a number of customers in which they have set up pricing mechanisms to be, really beneficial to them, in which there's multiple different metrics on which you're charging for your product because you want to capture every time someone gets value out of a product. And there's a different price associated to each one of these metrics. So you're within a software application and you're clicking around and, the vendor in this case is capturing all of the value. We've been able to create significant revenue for customers by simplifying that process in a way that, might seem odd because you're now not capturing every single point of value in an application, but by simplifying it on the customer side, you've enabled them to spend more money with you on other things. And often that's sort of a misunderstood thing in which pricing is really this balance of the value that the customer is getting out. And when you can get that, teeter-totter at a nice balance, it ends up creating better revenue opportunities for anyone in the space.
Well, thank you so much for joining me for the discussion, Michael, and for everybody who joined us to watch. If you're not already, get connected with him on LinkedIn, and certainly let either one of us know if you've got any questions. But thank you again for your time, and have a wonderful day, everyone.
Yeah, thanks for having me, Emma.
Thanks for joining us for this episode of Leading Change. If you like what you saw, be sure to come back on a weekly basis and subscribe for more expert interviews focused on digital transformation, change management, and emerging technologies.